On June 6th, the European Central Bank announced a 25 basis point interest rate cut. Let's look at the risks inherent to this decision and how they can be managed. First and foremost, there is a risk that inflation in the Eurozone will return. The Euro area annual inflation rate was 2.4% in April 2024. This is stable compared to the previous month. A year earlier, the rate was 7.0%. This is higher than the long-term average of 2.04%. The annual inflation rate in the U.S. is 3.3% in May 2024, the lowest in 3 months, compared to 4.05% last year. The Federal Reserve targeted rate of inflation is at 2% over the longer run. It seems that the Eurozone is better able to keep its inflation under control relative to U.S. How is Europe able to manage this? Geographically speaking, the Russian-Ukrainian conflict has a more direct impact on European prices, especially on the energy and food perspective. Why is inflation lower in Europe than in U.S.? This main reason lies more with U.S. than with what the Europeans did. During the global pandemic in 2020, the U.S. government abused its right to print money. They had printed it excessively to the point beyond control. After the pandemic, we would expect the U.S. to limit its reliance on printing money to resolve its issues. However, this has become a habitual behavior for a quick fix to any domestic issues the U.S. government encounters. In the last presidential election in 2020, the U.S. government sought to win votes and printed even more money to stimulate the economy. As a result, the total amount of money in the United States, which is M2, increased significantly by 36% compared to the end of 2019. Spamming money in the economy has led to the case of runaway inflation rate. Comparatively, Europe has taken a more cautious approach in printing money. As of 2023, the total money supply in the euro area is higher than that at the end of 2019 by only 22%. This is over a period of 3 years. The increase is much smaller than in the United States, which increased its M2 by 36% over 1 year's time from 2019 to 2020. Europe has not printed its currency indiscriminately. They had learned this lesson through the painful periods leading to the Second World War, where the vicious inflationary pressures in Germany eventually led to Hitler's rise to power. The next risk that is inherent to ECB's interest rate cut is the loss of capital. No doubt the interest rate cut will widen the U.S.-European interest spread, leading further to flow of funds out of Europe to U.S. If the global flow of funds is not properly managed, the Eurozone is at a risk of running out of funds and the entire European economy may crash. So why would Europe still take this risk? Well, the ECB is really left with no choice now. The higher interest rate is hurting their economies and there is no better way to save it. Besides, it is also making a bet. There is a chance that the interest rate cuts will spur the economy into recovery by lowering business cost and improve productivity. This will be the hedge against capital outflows and rising inflation. Cutting interest rates will very likely lead to further increases in inflation, but if the economy can recover, businesses can create more wealth to increase people's income. This will in turn increase the government tax revenue. If the increase is more than that of inflation, then the rate cuts will be a cost-effective measure. As for the flow of funds outside Europe, this may happen in theory. However, there has been an intriguing exception to this phenomenon, that is China. Contrary to the global interest rate hike, not only has China not joined in the raise, they have instead managed to cut their interest rates slightly over the past 2 years. Although China experienced large capital outflows, both their exchange rate and foreign exchange reserves have been resilient. Something seems to offset the effects of capital outflows in the case of China. Although there are many reasons pointing to why this might be happening, it had been argued that lowering of the interest rates in China has led to reduction in business cost, which in turn triggers higher productivity. This has helped to increase wealth generation in the business sector, acting as a hedge against the negative impact of capital outflows. However, we cannot compare apples with oranges. Europe's economy is not the same as that of China's, and these are two very different economies after all. While it is unlikely that the Eurozone can replicate the same success of China's economic policies, there are unique circumstances in Europe which it can leverage on under this current global macroeconomic environment. Interest rate cuts at this point in time may have minimal impact on their flows out of Europe. U.S. interest rates are currently at a 23-year high of 5.25% to 5.5%, while in the Eurozone, the ECB is currently holding rates at record highs of between 4% and 4.75% before the cut. The difference with the U.S. interest rate is less than 1.5%, which is far less than that between China and the United States. China loan prime rate is at 3.45%. The bigger the differential in spread, the higher the opportunity cost not to move the funds to US. The limited US-Europe spread may not be attractive enough for investors to pull out their funds from Eurozone yet. Besides, Europe had already suffered from the first wave of global funds pullout during the Russian-Ukraine war in 2022. Whatever funds that is left in Eurozone today represents those funds that are either difficult to be moved out or funds that are unwilling to exit the region. This means that the impact of the ECB interest rate cuts has very limited influence on the flows of these remaining capitals. Another reason that global investors will consider is capital preservation. From investors' perspective, capital preservation is more important than capital growth, especially so during times of uncertainties, which is when fear outweighs greed in the market. In our current macroeconomic environment, the risks of capital loss had started to accumulate. Global investors are increasingly sensitive to changes in the global investment climate and attitudes. In US, the Federal Reserve is coming to the end of the cycle of rate hikes. The signs reflecting the current pressures in US economy are becoming more glaring, and it is only a matter of time that something bad will happen if the current rates of interest continue to climb. Even maintaining the existing high rates is not viable for long periods. With the drawbacks becoming increasingly obvious, the risks of an economic crash in US is also building up. Sure, the 5.25% to 5.5% interest rate in US is very attractive, but only if safety can be guaranteed. The US financial system may collapse one day, and when that happens, it will be too late to move the capitals back to Europe and investors will suffer huge losses. To make things worse, there were recent reports in late May this year that Yemen's Iran-backed Houthis launched a missile attack on a U.S. aircraft carrier in the Red Sea, after they threatened to escalate attacks on Red Sea shipping in response to overnight strikes by the United States and Britain that killed 16 people. Although this report has never been affirmed by U.S. officials, during sensitive times like this, the psychological state of global investors is very volatile. They are likely to remain extremely prudent, and they read into all signs of potential cracks in the U.S. This includes not only their economy, but the other pillars that represent the foundations of U.S. strength, especially its military. In the next video, I will discuss how the U.S. was able to transfer the wealth of other economies to itself using its financial systems, and why this system of wealth transfer has not been effective in recent times. Please keep a lookout for my next video if this topic interests you.